Well, the man who is known for moving markets is on correction watch. Marko Kolanovic joins us now for his first TV interview since leaving JPMorgan last summer. He was the firm's chief market strategist, co-head of global market research. He joins us here on set. Marko, it is great to see you.
Thank you. Great to be here.
So you're looking for a garden variety pullback. Does anything change based on what has unfolded this afternoon?
I mean, a little bit, because we got close to all-time highs. I believe Nasdaq was 1.5%. And then you had the sort of Tesla, you have Palantir, you have a bunch of these momentum stocks taking quite a bit of beating. So it does remind me on what happened in February 19, if you remember. That was when the sort of Palantir went down and then momentum stock unraveled, So I do think that could be a catalyst for a bit of a correction because close to all-time highs, but we still have all the problems. We have a trade war. We have the sort of signs of economic slowdown. Valuations are back to highs. So that's sort of what I'm kind of expecting, a little bit of a pullback here.
Does that negative political backdrop, has it gotten worse based on what we've seen this afternoon between President Trump and Elon Musk, or is that a sideshow?
I think it's a little bit of a sideshow. It's important for a certain company, and it can spill over. Because if you look at the Tesla, is one of the biggest holding of retail investor. There were like kind of a little ecosystem of stocks around it. So I think it could be a little bit of a catalyst, although I think much bigger problems are sort of what we saw, for instance, last 3 days with ADP, with initial claims, with challenging job cuts. I think that's like a real problem. And the fact that we have this trade war, which almost nothing is resolved yet, right?
Marko, a lot of folks want to focus on corporate earnings and really growth, right, as they think about the stock market and potential gains. But one thing that's really important, if you go back to, let's call it early April, when we didn't have a lot of clarity, we had a careening stock market and we had the U.S. dollar, well below, below 100. It got down to 98 or something. That's a U.S. dollar index. And we also had 10-year yields, which were much lower. Now they're much higher, 4.4%. How important is that disconnect, in your opinion, as you think about the macro situation here? Because you have a stock market that's very close back to its prior highs, but you have the 10-year yield and you have the dollar trading near where they were when the stock market was much lower.
Yeah, so there is disconnect between dollar and 10-year, right? And 10-year, I think, is a problem, right? Because it sort of drives a lot of different things: real estate, commercial real estate, mortgages, all kind of things, right? Also, you need to compare equity risk premia and bond risk premia. What are you earning on equities? What are you getting from bonds? So bonds are cheaper than equities. Equities are expensive. So I do think that's a sort of a negative thing. There is a bit of also this standoff between Fed and the president, right? So everywhere else in the world, rates are being cut. Here, they are not. Eventually, that has to impact negatively risky asset classes here. So bonds sold off. A lot of different theories, from systematic selling to sort of this divesting of our trade war sort of counterparts, to sort of inflation, risk, term risk premium, all kind of different things. But that's a negative. It's a negative. I do think that bonds are probably oversold at this point. Last 2 or 3 days, we are seeing a bit of a rally. I think it's more driven by a weak economic data or signs, hints of weak economic data. So I think we could have a bit of a convergence there. So equity is a little bit lower, bonds a little bit higher, just to kind of equalize a little bit these two yields of risk premium.
So a couple things. First of all, Treasury yields were closed 1 year ago. The 10-year closed at 4.39. It closed today at 4.39. So, I mean, on some level, there's been much to do about nothing. I'd be the first. We've all said there's reasons why we've been concerned about bond yields. And it doesn't sound like you're terribly concerned about a big sell-off. I'm trying to qualify, first of all, garden variety means also opportunity. I'm looking at a market now that also over the last few months has seen real allocation internationally. Any thoughts on that? That's the kind of work you guys did at JPMorgan.
Yeah.
Look where people are positioned. And again, this U.S. exceptionalism trade is something that got a little long in the tooth.
Yeah, look, I mean, I was on a Dan's podcast back in November, and I said, go buy international stocks. They're cheap relative to U.S., but that has reversed a lot. I mean, look at the sort of DAX. That's a straight line up, to the kind of all-time highs. Situation there in Europe, there is a trade war. They do depend on exports a lot, right? So I'm not so, sold that now is the time to go in that trade. I think that's sort of past, with many of these international indices literally at all-time highs in the face of trade war, global slowdown, valuations that are reset higher. I'm not sure that's the time now. So I would probably stay away from that. I mean, if you were in that trade, great. I probably even didn't expect it's going to go this far, right? But Europe had some sort of, measures to stimulate, and so there's some optimism there. I'm skeptical about that. So I wouldn't. I think probably wait it out a little bit in bonds. There are some cheap aspects of U.S. markets as well, and maybe wait for that, call it garden variety sell-off, that can be maybe, 5%, 10%, and if we still don't have the recession probability shooting up, then it's a buy opportunity, But I would keep an open mind that maybe at that point there is increased probability of recession, and maybe even that 5% is not a buy at that point.